Welcome to ARGUNAS Learn. We're kicking off Module 1.6 today, talking about behavioral biases. Now, what if I told you that the single greatest risk in investing isn't a market crash or picking a bad stock? What if the real risk is actually hidden inside your own mind? Yep, it's your own behavior. So that brings us to a really important question. Why do really smart, successful people so often make terrible, irrational, money-losing decisions when it comes to investing? Understanding this hidden enemy inside our own heads, well, that's the absolute first step to becoming a successful investor for the long run. And the answer is actually pretty simple, but it's also profound. The biggest risk isn't the market, it's us. Our own behavior is a huge risk factor. So let's unpack exactly what that means for your portfolio. Okay, let's start with a basic truth. We are not rational machines. We are emotional beings, right? And those emotions have a massive influence on our financial decisions. This is the perfect breeding ground for what we call behavioral biases. Just think about the big emotional drivers in investing. You've got fear, which drives people to panic sell when the market is down. Then there's greed, which causes us to chase after hot stocks right at their peak. And of course, there's hope, which can make us cling to a losing investment, just praying it'll turn around. The outcome is always the same. These powerful emotions completely distort our rational thinking, and they create these systematic errors so common that we have to classify them as a real financial risk. So let's go ahead and unmask some of these mind traps. We're going to break down the most common biases that can quietly, and I mean quietly, sabotage your portfolio one by one. First up, we have the availability heuristic. This is basically our brain's shortcut to make decisions based on information that's just, well, available. It's fresh in our minds or it's easy to recall. Picture this, a hot new IPO is all over the news, everyone's talking about it. It just feels like a sure thing because it's everywhere you look. The danger here is that you're focusing on all the market noise and completely ignoring the deep, fundamental research you need to do to see the real risks. Next is a classic, confirmation bias. This is such a human thing to do. We make up our minds first. Let's say we just love a particular stock. Then what do? We go looking for information that proves we're right. We only read the positive articles, we only listen to the good news, and we conveniently ignore all the red flags. This creates a really dangerous echo chamber and a totally false sense of security. Familiarity bias. We all prefer what we know. It's comfortable, but in investing, this comfort can be a huge problem. A perfect Indian example is an IT professional in Bangalore who only invests in technology stocks. Why? Because they work in that industry, they understand it, they feel comfortable, but what they're actually doing is putting all their financial eggs in one single basket. This leads to terrible diversification and a really high concentration of risk. Then there's herd mentality. This is pretty much the financial version of peer pressure. When it seems like everyone is rushing to buy a certain stock or asset, that fear of missing out, that FOMO, kicks in hard. And so we follow the crowd, often without even asking why. This is the exact behavior that inflates market bubbles, causing people to buy at the very top, and it's also what drives panic selling during crashes. Now, this next one is a really powerful one, loss aversion. Groundbreaking research by Nobel laureates Daniel Kahneman and Amos Tversky showed something incredible. Psychologically, the pain of losing money is about twice as powerful as the pleasure of gaining the exact same amount. Think about that. This simple imbalance has huge consequences. It causes us to hold on to our losing investments for way too long, hoping they'll recover, while selling our winning investments way too early just to lock in a small profit. And this imbalance is really at the heart of so many poor investment decisions. Gaining 5,000 rupees feels good, but losing that same 5,000 rupees, it feels disproportionately, overwhelmingly bad. This concept is absolutely core to understanding behavioral finance. Overconfidence bias. This one often strikes right after an investor gets a few trades right. They get a little lucky, and suddenly they start to believe they've cracked the code or figured out the market. They think they can predict its next move. And this leads to taking on way too much risk without proper analysis and often trading way too frequently, which just racks up costs and costly mistakes. And finally, we have recency bias. This is our brain's tendency to think that whatever has happened recently is going to happen forever. So if the market has been on a bull run for 2 years, we start to believe it's never going to fall. This causes us to take on more and more risk. On the flip side, after a market crash, we become too scared to invest, assuming the bad times will never end. Our strategy becomes dangerously short-sighted. Now look, these biases don't operate in a vacuum. our core personality plays a huge role too. Ask yourself, are you a natural spender or a saver? Your personal interests can also concentrate your risk. Think about a doctor who only feels comfortable investing in pharmaceutical stocks. And above all this, ethical and disciplined behavior is the foundation of everything. Taking shortcuts or bending the rules will always derail your long-term investment journey. So, what's the actual cost of all this? How do these mind traps translate into real, tangible financial harm in the real world? Well, the results are pretty costly. Familiarity and overconfidence, they lead directly to sector concentration, putting all your eggs in one basket. Herd mentality and recency bias, they cause those classic market timing errors, buying high out of FOMO and selling low out of fear. And here's the crucial takeaway. Many investors actually underperform even great investment products. It's not because the investment was bad, it's because their own behavior worked against their own goals. Okay, for those of you who are preparing for your NISM VA certification, let's switch gears and talk about how this very important topic shows up on the exam. Here is your exam tip. The NISM exam isn't going to ask you to just recite definitions from a textbook. It tests your conceptual understanding. What they'll do is give you a short scenario describing an investor's actions, and you'll have to pinpoint the specific bias at play. It's all about application, not just memorization. And here are the key concepts you absolutely must master. First, remember that these biases are not just feelings. They represent a real, quantifiable financial risk. Second, you have to know that being familiar with a sector is never, ever a valid reason to sacrifice diversification. And third, please understand that overconfidence during a rising market is one of the most dangerous traps an investor can fall into. All right, let's do a super quick recap. Number 1, your own behavior is a major, often hidden investment risk. 2, emotions like fear and greed will distort your rational thinking. 3, biases like familiarity and herd mentality are guaranteed to destroy proper diversification. 4, overconfidence increases your risk, while loss aversion leads to terrible timing. And most importantly, number 5, just being aware that these biases exist is the single most important first step to getting them under control. And that's it for this concept on ARGUNAS Learn. So now that we've diagnosed the problem, which is our own behavior, we can start to look at the solution. In our very next lesson, we are going to cover asset allocation, which is the main framework for building a disciplined strategy that helps manage these biases and, frankly, protects you from your own worst financial instincts. If you found this explanation helpful, please do take a moment to like this video, subscribe to the channel, and hit that bell icon so you don't miss our next lesson on asset allocation. This content is for educational purposes only. It is not affiliated with, endorsed by, or sponsored by NISM, AMFI, or SEBI. Mutual fund investments are subject to market risks. Please read all scheme-related documents carefully before investing.